Hey everyone, it's Julie here with Tip Ranks. Today we're taking a look at 3 unanimous strong buy stocks that have been dipping in price recently. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. For any of my Canadian viewers, I hope you had a great Thanksgiving weekend surrounded by family and friends. Today we're taking a look at 3 stocks that have been dipping in price. But analysts think that there's opportunity for a double-digit recovery. All 3 of these stocks today are in the red recently, but have unanimous strong buy ratings. So we're going to take a look at these companies, what it is that they do, and of course what those analysts are predicting for the stock's future. I found these stocks on the TipRanks stock screener. Found right underneath the screener menu, I put in a few different filters today, narrowing in on a medium to large market cap, an outperform rating on the Smart Score, double-digit upside potential, and a strong buy consensus. And that gave us a list of companies down below. You can try the stock screener for yourself on the TipRanks website or right on the TipRanks mobile app, which you can download using the links in the description below. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. Now let's dive right into our 3 strong buy stocks. First up, we're looking at a company called Marex Group. They trade under the ticker MRX, currently priced at $31.50. Now, overall in the past year, the stock is up 25%, but is in the red recently. In the last 3 months, it's fallen 21%. Marex is a leading global commodities broker and financial services firm headquartered in London. They specialize in providing a wide range of services across various sectors, including commodities, financial derivatives, and institutional trading. They offer expertise in areas such as energy, metals, and agricultural products, facilitating trading and risk management solutions from clients ranging from producers and consumers to financial institutions. There have been a couple of factors behind the stock's decline in recent months. They came out with both an earnings and revenue beat for their Q1 back in May. However, the stock did decline following. They had some slower than expected growth in some segments and cited that there was some uncertainty around potential global tariffs. Then, at the start of August, there was a short seller report. On August 5th, Ninja Research announced a short position in the company, saying that they believe Marex has engaged in a multi-year accounting scheme involving a web of opaque off-balance sheet entities, and that they are a financial house's cards, and the balance sheet is riddled with holes in financials that are unreliable. Of course, Marex did reject this, saying it was a malicious report as a transparent effort to manipulate the share price to enable Ninja to profit from the short position they previously built. And they noted that their Q2 results were coming up shortly, where they looked forward to the opportunity to update the market. That Q2 earnings report came out about a week later on August 13th, where they did report both an earnings and revenue beat. Earnings per share of $1.02 came in 9 cents ahead of analysts' expectations, and they reported revenue of $500 million for the quarter, up over 18% year over year, and record revenue for the first half of the year at $967 million, up 27%. They also ended the quarter with $2 billion in surplus liquidity. Just after that quarterly report, we did hear from an analyst at Barclays. They noted the company's earnings beat and that sales momentum continued into July, and they believed that Marex also provided a strong rebuttal to the recent short report, answering many key questions. The company's Q3 report isn't due out until November 6th, but with all of the recent price movement, they did provide a Q3 preview, where they shared they're anticipating revenue between $475 to $485 million. They are pleased to report another strong quarter in which they've maintained their growth trajectory, and growth was achieved despite a more challenging operating environment. The momentum with their clients continued into October, where they recently hit a record of over $10 billion in U.S. client assets. So with all this, the Marex stock does currently come in as a unanimous strong buy, with 7 current analyst ratings. And the average price target of $49 per share implies an upside potential of 56%. Looking at those recent ratings down below, we have quite a few 5-star analysts weighing in on the stock, which is always great to see. Those price targets range from an upside of 23% all the way to 83% upside. For our second stock today, we're looking at Merit Medical Systems. They trade under the ticker MMSI, currently priced just shy of $80 per share. They are in the red overall this past year, down about 17%, and have fallen 15% in just the last 3 months. Merit Medical Systems is a global healthcare technology company that designs, develops, and manufactures single-use proprietary medical devices. These are primarily used in interventional, diagnostic, and therapeutic procedures. Their products support minimally invasive treatments and are sold to hospitals, physicians, and healthcare providers worldwide. Their 2 main segments are cardiovascular, with products like inflation devices, therapeutic catheters, guide wires, needles, and fluid dispensing systems, as well as endoscopy, with endoscopy accessories, biopsy tools, and custom procedure kits. Their stock did take a hit back in July, where the CMS pass-through was denied for their product Rhapsody. That was for an outpatient rule proposal, and they said that they're still engaging with CMS to understand the decision and what steps are next. An analyst from Wells Fargo said they were surprised by the news and expect the company will appeal the decision. And with that, they now expected their Rhapsody sales to come in at the low end of guidance. Their next earnings report comes up at the end of the month on October 30th. This follows an earnings and revenue beat in the previous quarter back on July 30th, but the stock did fall over 9% in the following weeks. Analysts noted a tempered full-year guidance due to a challenging macro environment. Q2 earnings per share of $1.01 beat expectations by 16 cents, and revenue came in at $382.5 million, which marked a 13% year-over-year increase. They generated $70 million of free cash flow, which reflected a 20% increase. However, delays in reimbursement strategies and challenges in the Chinese market do present headwinds. On top of all that, Merit also just announced a new CEO last week, so a lot of things happening here with the stock. We did recently hear from one analyst at Canaccord Genuity. They reiterated their buy rating on the stock, noting that the company has demonstrated robust results in the first half of the year and raised their guidance, projecting significant year-over-year revenue growth. They're focusing on enhancing operational efficiencies, and they're actively working on securing reimbursement for their Rhapsody product, which, despite initial setbacks, does show promise for future financial benefits. With 9 current analyst ratings, Merit Medical Systems does come in as a unanimous strong buy. The average price target is $102, implying an upside potential of 28%. Looking at those price targets down below, all of them in the double digits, ranging from an upside of 18% all the way up to 35%. If you've made it all the way to our third stock today, then do me a favor and make sure you've hit that thumbs up button. Third on the list, we're looking at Corporacion America Airports. They trade under the ticker CAAP, currently priced just above $18 per share. Overall, in the past year, they're down just slightly at 1.3%, but in the last 3 months have fallen over 8%. They are a Luxembourg-based global airport operator specializing in airport concessions. They operate 53 airports in Latin America, Europe, and Eurasia, making them one of the largest private sector airport operators worldwide by numbers of airports managed. They focus on enhancing infrastructure, passenger experience, and sustainability while driving economic growth in local communities through tourism and job creation. Their revenue is primarily generated from airport concessions and includes aeronautical fees, non-aeronautical sources, and construction and development services. Their stock has felt the pressure of global uncertainties and tariff risks, and during their last quarter, which they shared on August 20th, they did have strong revenue growth, but a miss on earnings. Q2 earnings per share of 30 cents fell 13 cents short of expectations. On the bright side, they did see revenue grow 19% to $387 million. They also saw their passenger traffic increase by 13.7% year-over-year, with historical records in Argentina, Italy, Uruguay, and Armenia. And for the month of August, they did see passenger traffic increase over 10%. Their stock does just have 4 current analyst ratings, but of course comes in as a unanimous strong buy. And the average price target of over $24 implies an upside potential of about 35%. Looking at those ratings down below, they range from an upside of 15% to 54% upside. So that is a quick look at 3 stocks that Wall Street analysts remain bullish on despite their recent dips in prices. Let me know your thoughts on these companies and whether it looks like a buy the dip opportunity or if you're going to wait on the sidelines a bit longer. I always appreciate hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you always do your own research and due diligence. Thanks so much for watching. Have a great day, and I'll see you back here next time.